So we've we've shown that the financial sector is pretty big. We said it's kind of 8 to 9% of GDP in the UK, employs over 1 million people. But there are other big sectors. So what is it about the financial sector that makes it worthy of so much discussion? And the answer is that the financial sector is inherently risky. And so because it's big and risky, that means that we need to pay close attention to it, and it probably needs more careful regulation perhaps than the market for stocks. So what is it that makes the financial sector risky? The first is that it's inherently fragile. And the reason for that is cash ratios. Banks don't hold all of the money that you put into them in the form of cash. They take their customers' deposits and they lend those deposits to other customers. They buy shares with them and so on. And because banks, they pay you interest, so the only way they can survive is by taking the money that you've given to them and lending it to somebody else for a higher interest rate. And banks don't hold much cash. It's kind of I was going to guess at kind of 1 to 2%, and I had a bit of a look. In the US, it looks like based on the data there in the US, it looks like the average amount of cash that banks hold relative to their deposits is about 0.5%. So for every £100 of money that's deposited, they actually only keep 50p in the form of cash. Somebody was suggesting that in India it's more like about 4%. So this sense of about 1 to 2% is probably about right. It's difficult to get precise data. So what that means is that banks have outstanding loans of say 100 quid, but they've only got £1 or £2 in the form of cash. And that creates the obvious risk of a bank run. That's what happened to Northern Rock back during the financial crisis, which is that customers lost confidence and they then went to try and take their money out, which of course they couldn't, which then creates further panic because the bank wasn't holding enough cash. Therefore, even more people want to go and get their money out, blah, 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 blah. That's the end of the bank. If the bank goes down, well, that's clearly problematic, because if one bank fails, then customers in other banks, they're going to start thinking, oh my God, I'm going to lose all my money, I'm going to take my money out, and then we have the collapse of civilization as we know it. So that's not so great. But also, secondly, the financial sector is at risk of market failure. And there are a variety of ways in which the market might fail. The most obvious one is information asymmetry. Again, if you've watched The Big Short, then you'll have seen information asymmetry at play, via the mortgage brokers down in Florida. But just more obviously, we're dealing with even an ordinary loan is pretty complex. You look at the terms and conditions, they're quite extensive. When you then add that in, add into that an incentive for banks not to inform you, because they want to make as much money out of you as possible, and you've got the potential for problems. Back in the noughties, running through into as recently as kind of 4 or 5 years ago, there was the big PPI scandal. PPI was payment protection insurance, which was if you took out a loan, then in principle you could take out insurance, so that in case you couldn't repay that loan, the bank would pay the loan off for you, which is a perfectly sensible product. But what started to happen is that banks started to add payment protection in without telling you. They would tick boxes saying that you wanted it when you hadn't, and then that just added to the cost of your loan. That's a problem, and people didn't really know very much about it. In the US, there was the Wells Fargo scandal, where the Wells Fargo allegedly started opening accounts without customers' permission to meet sales targets. So that's clearly problematic. In the US, people ended up with poor credit ratings, which then damaged their ability to take out loans. Obviously, PPI is an obvious problem, where you're paying for something that you didn't want and didn't even know that you had. Secondly, there's a high risk of short-termism because of the way in which bonuses have tended to be paid in the past. And that encourages people. That encourages kind of brokers, employees of banks with bonuses to take big risks. Because they get their bonus, then they leave. So therefore, they'll take unnecessarily high risks because they can make a big reward in the short term. And that links to something called moral hazard. Moral hazard is the idea that the person getting the reward isn't the person that's taking the risk. And we saw that again with things like the mortgage bonds that became big during the Big Short. People making a lot of money on that were the people who arranged the sale of these mortgage bonds, the people who packaged them together. The risks were with the final owners of those things, and again because of information asymmetry, all these things were rated very, very highly, very safely, AAA, when in fact they weren't. So therefore, people were taking risks that they didn't really understand, or didn't even know about, but the rewards were going for somebody else. And so again, that's a big problem. The same with, again, if you watch The Big Short, the mortgage brokers. So we got information asymmetry. That was also true of the complex financial products that became popular during the run up to the financial crisis, where again people didn't really know what they were buying. Short-termism, moral hazard, and also kind of this idea of it's a general problem. A race to the bottom. It's quite common in oligopoly markets where you've got a few firms where they're just trying to outdo one another, and in the US, the deregulation and privatization of credit rating agencies appears to have created a problem, whereby they were competing to give good ratings, irrespective of the kind of true validity of the underlying assets within that. So taking all those things together, you've got a problem, which is you've got a sector that's very big, very influential, affects us all every day, has a major role in the economy, but it's inherently fragile, and it's also prone to market failure, and particularly because of information asymmetry. And as a result of that, it's probably going to need regulation, and more regulation than other, perhaps less sensitive sectors.